This is FedWatch on Zacks.com. The Federal Open Market Committee has released another decision on interest rates. Well, the word on interest rates is that the Fed is staying the course on them and Treasury purchases as well, as expected. Here to talk about the rest of the FOMC statement is our senior market analyst, Charles Rotblatt. This is probably one of the more upbeat statements that we've seen in a while.
Yeah, they definitely changed their stance on the economy. It was what I expected them to say, but when you look at the statement, the June statement instead versus the April statement, I have both of them in front of me. Not that our viewers can read it,
right.
But one of the key phrases in there in April, they actually talked about how the pace of contraction appears to be somewhat slower, and now they changed it to say that the pace of contraction is slowing. So taking out that word somewhat and really taking a more firm stance that yes, things are getting better. And when you look at the economic data across the board, we are definitely better now than we were 4 months ago.
They say inflation remains subdued, or is likely to remain subdued for some time. Core inflation is probably what they're talking about. So they really have no reason to change course at this point.
Well, one thing, and the reason why we saw an immediate negative reaction to the statement was some people were expecting an exit strategy.
Right.
And I think the goal of the Fed right now wasn't so much to worry about what's going to happen over the long term, but really keep mortgage rates in check right now. We have seen mortgage rates rise, and it's a concern because although existing home sales have risen for 2 consecutive months, new home sales have really been flat over the last 4 months. They really have not changed since February. And when you look at expected rising foreclosures, rising default rates, the likelihood that unemployment will stay at elevated levels, the housing market's not coming back anytime soon. We might have flattened. It appears the housing market has actually hit a bottom, but we're not going to see this great improvement. And you do have to worry that if mortgage rates start creeping up at a time that people are concerned about their jobs, they're still having difficulty getting mortgage loans. And if you're someone who either hasn't bought a house or maybe you want to upgrade to a bigger house, there isn't this big incentive to really move now. Yes, there's an $8,000 credit for first-time home buyers, but then you got to consider, okay, you're getting this credit, but anytime you buy a house, as you all know, and certainly as many of our viewers know, there's a lot of cash involved with actually buying the house. It's not only your closing transaction, but there's always some repairs that need to be done. There's things you want to do into the house, replace the carpeting, change the toilet seats, whatever. A friend of mine, absolutely adamant, first thing you do when you move in the house is replace the toilet seats. But there's just there's little things like that which consume cash. And so if you're worried about your job or maybe your salary's been cut or your bonus has been taken away, all that plays into a role. So I don't think we're going to see this rebound in housing anytime soon. And I think the Fed's seeing that and are looking at mortgage rates going, we need to talk these rates down a little bit and kind of keep rates artificially depressed for the time being if we really want to see the economy move from a period of slower contraction to actually showing some growth, which despite all the improvement in the economic data, it's very important to realize we're still contracting. We have not gone from a period of contraction to growth, just a slower period of contraction.
Might we be entering, as some fear, a period of stagnation?
I don't think we're going to be in stagnation. I mean, I think the economy, we're going to enter a period of slow growth, and certainly we're not going to see stagflation, but I think it'll be a period where we're going to have slow growth. It's not going to feel like a recovery to a lot of people, but I do think throughout 2010, we're looking at probably 1 to 2% growth, and that's in line with what most economists are going to say. 2011, we just don't have any visibility, but I think people need to realize that we will enter this period of slow growth. For the markets, it could mean that we eventually end up in a prolonged trading range, which will put a greater emphasis on stock picking and being in the right industries. But I've said before, I don't expect this big V shape where we've hit bottom and suddenly we rebound. I really think it's going to be kind of more of a slow, gradual increase. And for a lot of people who are out of work or are in industries that have been hit hard by the economy, unfortunately, it's not going to feel like much of a recovery at all. Sad, but that's just going to be the reality.
What do you think we'll see coming out of the FOMC in August?
Still no change in interest rates. When you looked at the Fed fund futures heading into this meeting, they weren't expecting any. The Fed did again state that they intend to stop buying treasuries in autumn. Obviously, autumn's kind of a vague term. but possibly in August, maybe they'll tweak it a little bit, talking about whether or not they're actually going to be done buying treasuries. That's the one time where we could see some kind of an exit strategy. But I do think we're going to have to see how second quarter earnings play out, see what kind of visibility companies give, and also make sure we have confirmation of this continuing improvement in the economy. So we've got 6 weeks between now and then. Let's see how things shape up before we can actually say with certainty what the Fed's going to do.
All right, the Fed's staying the course on rates, but a little bit more upbeat on the economy this time around. With Charles Rotblatt, I'm Terry Ruffalo.